For more on this, we're joined by Mark Humphery-Jenner, Associate Professor of Finance at the University of New South Wales Business School. Welcome back to the programme, Mark. Now, Chairman Powell warned against political pressure, but with Trump demanding faster cuts, can the Fed actually hold its ground in the year ahead?
Well, firstly, thanks for having me again. And in relation to the Federal Reserve, Chairman Powell is absolutely right in that you need an independent Federal Reserve or an independent central bank. Otherwise, you run the risk of a government that wants to get access to cheap capital, forcing the central bank to lower interest rates, and then spending all of the money, thereby driving runaway inflation that you don't get on top of. Inflation ultimately is an indirect tax on everyone in the economy. So he's absolutely right there. Now, in terms of President Trump, Jerome Powell's term is coming to an end in 2026, and that effectively means that Jerome Powell, well, the pressure on him is effectively going to end almost tautologically. His term is not going to be extended. He will be replaced. Now, the real question is whether his replacement is either going to be A, more aligned with what President Trump wants, and or B, more open to being, pushed by the president. Now, most of the candidates seem like they're unlikely to be pushed by the president, in large part because they value their reputation more than they value being, well, akin to what the president wants. And that appears to be the case across the board with all of the candidates that are being considered. Now, in terms of whether they might be more aligned with President Trump, it does look like he's going to pick someone dovish who will take over from Jerome Powell, thereby causing rates to remain lower for longer. So the pressure here appears like it is going to be more implicit and more through the appointment process than it really will manifest explicitly, because most of the Federal Reserve candidates are going to resist it.
Right, and as the world is cutting rates, Japan is doing quite the opposite. Could that massive policy split cause chaos for currency markets this year?
Certainly, it will be interesting to see how this plays out. Now, to some extent, currency markets have factored this in, similarly with equity markets as well, because people can see that they are headed in different trajectories. And indeed, in some ways, it's actually good that Japan is finally on a rate hike type cycle, or at least a higher rate cycle. The reason Japan had such low interest rates, of course, was deflation. And now breaking that deflation cycle is inherently good for Japan. Because deflation undermines consumption, which undermines growth, which also undermines your tax base because you get less consumption going on and therefore less employment. So it is important that Japan has a low level of inflation. It is also important that Japan's central bank gets on top of inflation to avoid it getting out of control. Now, in terms of the ramifications for currency markets, absolutely it will impact things like the carry trade, whereby people are perhaps borrowing in one currency, lending in the other currency. It will impact the attractiveness of this. But as long as it is ordered and predictable, we're likely to avoid chaos. Some of the chaos that occurred in the past was where there was something really unpredictable occurring, which caused people to have to unwind their trades. And that's probably the risk factor people need to be bearing out and considering, do they need to make hedges against really unexpected outcomes? But as long as it's orderly, we're not likely to see too much chaos.
And looking over at stock markets, they've started the year off higher. How optimistic are investors about the year ahead?
Investors appear to be reasonably optimistic. Indeed, if we look at analyst consensus forecasts for many major indices, particularly in the United States, we're seeing analysts expect upside. Now, the magnitude of the upside, of course, varies a little bit day to day, right? As the market goes up, then the delta between the forecast and the actual market value will vary. But markets and analysts, rather, do appear to be at least reasonably bullish on markets broadly. However, you do see some commentary around specific sectors of the market, and the commentary varies. So, for example, Michael Burry, who is perhaps known for being permanently bullish, he called out Tesla for, in his opinion, being very overvalued. Now, the market doesn't appear to really agree with that, hence why Tesla is trading at the price it is. But still, you're seeing not everyone agree with the bullish sentiment. Similarly, you get some concerns about AI, although that hasn't really borne out in valuations at the moment. Some of the concerns, of course, involve allegations that some of the revenues are slightly circular, i.e. it's company A selling to company B, selling to company C, which is ultimately buying from company A, creating a degree of circularity. And that's not per se a problem other than the fact that it creates a big risk if one of those companies ends up underwater. Further, there's allegations or at least concerns that some companies aren't fully factoring in the capital expenditure that will be required for AI and data centers going forward. So it is important to be cautious, and analysts are certainly factoring in some of that caution, particularly as it relates to big tech companies. But broadly at the moment, the consensus appears to be for a positive 2026. But of course, if interest rates start going back up, well, we'll see what happens then.
Mark Humphery-Jenner in Sydney, thank you very much as always.